I've been an accountant for 18 years and I run my own accounting firm called Box Advisory Services. And let me tell you, most business owners I meet are walking around with a structure they've outgrown and they don't even realize it. It's important to reassess your business structure as your business grows because it will affect how much tax you pay, whether your personal assets are protected, how easily you can scale, and if your growth is actually sustainable. That's why in this deep dive, I cover the 3 main stages of business growth and what you need to consider at each stage to make sure you're choosing the best structure for you and your business. Let's get into it.
The main thing I want to talk about, let me just share this screen, is that there's actually 3 stages of business growth, at least like what I want to call it. The 3 stages of growth regarding structuring. First one, I usually call it the startup phase. And then the second growth stage is actually scale up. And then the third stage, a de-risk and protection stage. So that's the stages of growth that I prefer clients thinking about. Okay, so let's start with startup. Usually when you're starting up a business and for growth purposes, you want something simple, you want something easy to manage, as well as it's cheap because it has to be cost effective. You can't be, for example, when you're learning how to drive, buy a Lamborghini because it's going to be very costly, insurance is going to be very expensive, and if you damage the car, then you're probably going to be left in a lot of debt for a very long time. So that's why you don't go buying a Lamborghini when you firstly start driving or learning how to drive. Same thing applies to business. When you first start a business, get something cheap, get something that's manageable, not complex, so it's simple, as well as it's easy to run as well. Because the more complex it is, the more confusing it is, it then becomes a chore for you to try to figure things out when it comes to taxes, accounting, bookkeeping, as well as compliance. And then you spend less time running your business and learning how to make money and more time doing admin work. So that's why I always say first stage is startup and always try to keep it simple as possible. And simple meaning either set up as a sole trader or set up as a company. And I think I have a good structure here, which it kind of explains that pretty well. The first structure or first startup phase for the stages is option 1 or option 2. And sometimes people don't do option 1, which is sole trader. They move straight to a trading company. And the reason why is because they need shareholders, they have business partners, and they also earn income in their personal name. So stage 1 could be like setting up a trading company. Okay, so when your business starts growing then and you start making more money and you're scaling up, that's when you jump onto stage 2, which is scale up. Your goal for your business is to grow as fast as possible. You're starting to make money, your clients are coming on board, you start building a reputation for your business, and as a result, there is more money and more profit. And you feel like there's an opportunity for you to grow even more. So as a result, the goal for us is to minimize the taxes as much as possible so you can reinvest the money for growth even more. So that's why I call stage 2 the scale up process. And scale up usually means that you start setting up a hybrid structure. You may not have a bucket company, you may not have a SMSF, but you may then have a trust that holds your company, and it gives you the flexibility to minimize your tax by distributing profits to further individuals in the family, or even enjoying like a good tax rate of 25% in your company, and then a good tax rate in your personal name at maybe possibly 30%. So we start looking at where's the best possible way to keep the profits to minimize your tax within your family group. And that's where option 4 comes in. All right, so that's stage 2. So that's just a quick summary of stage 1 and 2. And stage 3 is de-risking and protection. So going back to here, let me get rid of my adjustments. That's when you start looking at SMSFs, bucket companies. When you start running your business and you start making a lot of profit and you want to start taking the profit, the next goal for you is, how do I protect the money that I've made? How do I protect the wealth? How do I protect those assets? And that's why stage 3 is to de-risk and protect your business. that's where you start separating your businesses and pulling it apart and putting the risky assets or risky activities in separate buckets rather than keeping it all in one bucket. Maybe not even activity. It could be just some assets that you know that you want to keep for long term. So you start looking at a SMSF, a super fund, you start looking at a bucket company, so where you can keep some of the cash and the profits. And then you might jump on more riskier ventures or, play with the money that you have right now. So that's why in stage 3, it's all about de-risking and making sure that you protect your assets and protect the wealth. And the funny thing with accounting is that a lot of accountants kind of generally just give you advice on how you set up, which is option 1, 2, and 3. And then they just stop there. And that's the part where a lot of businesses tend to not get the right advice. And then as a result, they don't learn like the 3 stages of growth where they should think about startup, scale up, and then start de-risking and protecting. Some accountants go straight to stage 3 and then they talk about all these structures. And it's amazing, right? Like you can have a meeting with an accountant. The accountant starts talking to the clients about bucket companies, holding trusts, trading companies, SMSF. But if you don't even generate enough profits, then you're just spending a lot of money in terms of compliance costs. Because trading company could cost you about $3,000 to $4,000 in costs, and then the bucket company could cost you about $2,500, and then SMSF could cost you about $3,000, and then the trust itself can cost you $1,500, and then your personal tax returns $300, right? So if I add all that up, that's about $10,000 a year that you're spending, and that starts getting really expensive, especially when you're not generating the profit that you want. That could be like 10% of your actual profits. Oh, sorry, not even profits. It could be profits. 10% of your profits. Even worse, it could be 10% of your income. So that's why there should be stages for growth. And you shouldn't always consider moving straight to option 4, which is more de-risking and protecting your assets, because maybe there is no assets to protect in the first place. Obviously, jumping into option 4 is the easiest and smartest thing to do if you've got the money and you've got the assets already. It's easier, so you don't have to think about structuring later on down the track. But not everyone has the opportunity to have the money to spend 10 grand a year on their structure, as well as they don't have the luxury of understanding how this all works as well. Because if you there's a lot of clients that come on board with us from previous accountants that they say, I've got a bucket company, I've got an SMSF, and I've got a trust. Since I've set it up, I haven't actually used it or heard of the company or the super fund for the last 2 years. And that's where it's like kind of like a waste of having all those extra costs and those entities set up. That's the 3 stages of structuring for growth. All right, but let's dumb it down a bit and then start with stage 1 again. As I mentioned to you guys, stage 1 is to start off as simple as possible, as cheap as possible if you want, and keep it easy to run. So this is stage 1, which is startup. And let me go more on the specifics of stage 1. So stage 1, I usually offer 3 options for our clients. And what I want them to consider is the tax rates, simplicity, the income level of their business or how much they make personally, asset protection, short-term goals, succession planning, property investments, if they're planning any property investments, if they have any exit strategies in the next year or 2, or even, like any CGT concessions that they want to be aiming for, and superannuation retirement. Yeah, so they are the things you need to consider. So if a client came to me and they said, Davey, I'm wanting to open up a gym. I've got, my income, I think with the gym will be about 200K. So 100K as a salary, and then probably about 100K in profits. And my property, like my assets, is just like a house. That's my home. Okay. And nothing plans yet. I'm just starting off my first business. No property, no other investments. No, maybe one day I might sell my business. But right now the goal is to build that gym and maybe open up multiple gyms. And that's usually the main goal for most businesses. They just want to grow the business as much as possible and then possibly one day possibly sell it or just reinvest the money. So reinvest money into property. Okay. Generally, that's most people what they want to do. So this is a gym business owner. So in this case here, if it was a gym business owner and there's a sole trader, he could always open up the business as a sole trader. It's very simple. The cost is only like about anywhere between $300 to $1,200. Could be more, could be less. Just depends on how much work they want to do. And then also it's simple, right? You don't need to lodge multiple tax returns. You just need to lodge one tax return in your personal name. However, there is cons, and the cons are basically if you get sued, they go after the owner, and the owner is you. And so therefore your assets plus personal assets are tied into it. Personal assets are at risk. So these things here make it that it's a bit more risky. Okay, if the business wasn't a gym and the business was just PT, there may not be that much risk except for the house. However, because it's a gym, there is a lot of investment that goes into a gym. Most likely he will be spending anywhere between $200K to $500K in cash injection. He would also be signing a lease that would have a lease of at least 100K plus for say 5 years. So that means about $500,000 that he could be up for the next 5 years. By doing that, he may prefer having a company because he's separating his personal assets, so assets in his personal name, and maybe if he has a partner or if he has a business partner, they may have their own personal assets, which is a home, and they might have the company that signs a lease that also has the trading and also manages the business through that company instead. So that's why it may be better not to move as a sole trader or set up as a sole trader, but set up as a company in the first place. Yeah. So, and the cost for a company isn't that expensive. It would probably cost you $1,100 to set up. And then it will probably cost you anywhere between $3,000 to $4,000 in fees to manage the admin side and the accounting side per year. So trading company might be the next option. Some clients prefer a trust instead because they've got a lot of family members, they're low income earners, and they like the benefit of using a trust where they can distribute profits. They like the anonymous, that it's not under a company and the directors is actually under a trust. It's harder to find, harder to know who the owners of the business is. So sometimes a trust is also an option as well. I tend to not like trust as a trading entity. And the reasoning behind it is the trust doesn't pay tax. Trust doesn't pay tax, right? So that means that the trust needs to distribute the profits to the beneficiaries. And the beneficiaries are usually the individuals. And so if you're making about 100K in salaries and another 100K in profits, you could be at the highest tax bracket of 47%. And if you've watched my videos, you understand how that works with the tax rates. But over 190K, you're at the highest tax bracket. So every dollar that you're making over 190K gets taxed at 47%. And the trust doesn't allow you to pay taxes. It makes you distribute the profits to. And the only problem is you only got these individuals to distribute the profits to. Then that's where you pay a lot more tax. A lot of people then talk about, or maybe I can set up a bucket company later on with the trust where you can distribute the profits to a bucket company. But then my argument is, why don't you just keep it simple and have the trading company hold the business, and then you can have a 25% tax rate, which is better than the sole trader at 47% if you're high income earner, or individuals 47%, and it's cheaper because you don't need to have that trust there, especially when you first start off. That's basically stage one. Thinking about these things to consider: assets that you have personally, the investments that you want to invest into the business, the cash that you're spending on, also the risk of running a business. Like I said before, if you're a PT trainer, like the transactions or the activity you do with your clients, if you were to get sued by the client, how much would they sue you by? Not as much, because the transaction you're charging them is probably maybe $100 a week or $200 a week. Whereas if you're a gym, it's not just your clients that could sue you. It could be your suppliers. If someone gets hurt at the gym, when you're not around, when it's 24/7. They could sue you not just for the fees, but they could sue you for damages and injury. And with a PT, less likely for you to be sued because you're just advising the client. Obviously, you're watching them and you're trying to protect them, but you also got your insurance to cover you for your professional indemnity. So that's why a lot of PT trainers are sole traders, because cost is cheap, it's simple, and there's not much for them to risk in terms of assets and for them to be sued for. So and their activities are quite low. They're only making about anywhere between $50,000 to $100,000. So if they were to get sued, what can they really sue for damages for? But whereas a gym, someone can hurt themselves at the gym. A supplier could be dropping off supplies and they hurt themselves, or something happens to the shop, or there's a whole bunch of things, or the landlord can sue you as well, because you don't you damage the building itself, or you just can't afford to pay for the lease. So therefore they'll go after you 5 times the annual lease. So therefore then that could be like $500K. So that's a lot of money. So that's why it's a good idea possibly to separate the legal entity and have it as a trading company. Whether you sign a personal guarantee, you have to speak to a lawyer. Some landlords they require you to sign a personal guarantee as well. But the main thing that you want to protect, even though you sign a personal guarantee, is all the other activities that you may do when you run a business that they can go after you for. So that's why it's always a good idea to look at option 1 and 2. Option 3, like I said before, it is a possibility. It's only special cases that I think it's a really good idea to run a business through a trading trust. I usually don't like trading trusts. I usually prefer it as a company over there.
Sorry, Davey, I've
Okay.
got a question. What situation do you think would be appropriate to have that trading trust bucket company arrangement?
I used to see this a lot back in the day, but I don't see it as much anymore. When you have a lot of family members, what generally happens is that not all the family members work. So you might have mum, sister, brother, or anything like that. So let's just say this is mum, sister, and brother, and then this could be son that's working. All right, he generates this. He starts a business, and then all of the mum and sisters and brothers are working in the business as well. It's a family business. And what's the most common family business you have? Mum decides to open up the Mighty restaurant. All right, when you open up a Mighty restaurant, what generally happens is you spend a lot of money in the business, say about 500K, to invest in shop fitting and stock and all that stuff like that. And when you start the business, you don't just generate and return your money straight away. It takes a bit of time. It might take you 2 to 3 years to even 5 years to get your money back in terms of the investment. And you're selling products that could be anywhere between $10 to $30. So there's a lot of products you have to sell. So what generally happens is restaurants are not just like product or food intensive, it's also labor intensive as well. So you then get your family members to work for the business as well. So when you do that, what happens is this is like a structure where a trust is quite useful, because if once you set up a restaurant and it does well, a lot of the business owners, if they're smart, they would sell their restaurant after. So they set up the business and then sell it after. So the beauty of having a trust is the fact that you don't need to put everyone on payroll. You can distribute the profits to them on a regular basis, or sorry, not a regular basis, but annual basis. And you can just look at their tax rates. So let me just go up to open up a tax rates. Generate all the profits in the company, in the bank account, tax rates individual. And then at the end of the year, work out how much profit that the business has made. So let's just say the business made, say, $300,000, right, in profit. We've been taking money out of the business to pay for mum, son, and sister and brother, but we really haven't taken consideration all the taxes. We haven't taken consideration all the super. So they see the restaurant as their retirement plan. And this happens a lot for a lot of family members. And then what happens is that they've made 300K. And what simple maths is you can divide it by 4 and you split every one of them 75K. That means that we're keeping the tax rate at less than 30% when you average it out. So that's kind of like the argument. However, you don't need to pay super, you don't need to deal with the taxes, and you pay the taxes next year when you lodge your tax returns. So sometimes people prefer this. And the beauty of having a trust as well is that when you do sell the business, you sell the business and you still get the 50% discount on CGT when you sell a business because it's through a trust. Whereas if you sold it through a company, you don't get the 50% discount. So a restaurant does sometimes work, but it depends on the profit. Okay, so let me just change this scenario. Let's fast forward it a few years. You start this business, it does really, really well. There's lines out the door. You set up like not just one restaurant, but then you open up another restaurant in the next suburb, and because it's so busy. And then you've got 3 restaurants. And then what happens is your profit then changes to, times 3. Okay, then your profit is like 900K and you split it between the 2 or 4 parties. What happens there? Everyone's on 225 and then your tax rate's at 47%, 45, 47. Terrible move because now your taxes are really high. So that's the income for the individuals per person. That's why restaurants are great if you've just got like a family running it and it's just going to be a family business. The goal isn't to grow that fast or that much. But that's why a trading trust is great if it's like one restaurant and a family business and the growth isn't that extreme. But if you're thinking of growing an empire with multiple restaurants, a trading trust isn't the best. One last thing I forgot to include is that when you do invest the 500K injection, you got to understand that 500K injection is for shop fitting, it's for supplies, it's for startup costs, and you get to claim those startup costs as well, which would lower your profit as well. So if your business is like at the 300K mark because it's just one restaurant, the profits won't even be that high as well because you get to claim depreciation on the shop fitting and all that stuff like that. So that's why a lot of restaurants set up as a trust. My favorite isn't my favorite. I still disagree with it. I still feel like a company is a better idea. And the reason being is because of the 25% tax bracket. And I always ask clients, what's their goal? They always say they want to open up multiple restaurants. So I usually tell them to bite the bullet and have a company instead. And a lot of them don't want to consider about selling. That's what I prefer as well. Yeah. That's why I'm actually not a big fan of trust. But I can understand other accountants explaining the reason of, setting up as a trust instead. So possibly worth adding, if I'm correct, the government R&D tax incentive scheme is not for trust. Yeah, that's a really good point, Barry. We live in a society, and I tell this to our clients all the time, but we live in a society that the government and a lot of old school mentality, they treat businesses as companies. They don't like trust. So, and the reason being is because it's very anonymous. So it's supposed to be created in a way where not many people know who actually owns the business or the assets. And so the government won't give benefits to a trust because they don't know who the owners are and they don't know what the point of a trust is. They know that a lot of people set up trusts to try to minimize tax. And so therefore they're not going to reward you by setting up a trust. That means that the grants that you can get are more tailored towards companies. So you kind of lose some of the concessions of having a trust because you don't get the R&D grant and tax incentive. If you don't know much about the tax incentive or R&D, is basically if you spend money on R&D, which is you building like a new product that's never been before seen, or spending money on investing into a research and development on a process or a new scientific technology or whatever it is, then you can get like an incentive of like 20-30% of the money that you spent back in your pocket so you can spend more. That way here, it just increases the runway of you spending all that money to invest in R&D. So that's what R&D is, but they don't give it to trust because they don't know who the owners are and they don't want to. There's a lot of like, the 50% discount already for trading trust, So therefore they don't give too much benefits for a trust. So that's why trust is not very useful for businesses. It's actually better to set up a company. And that's why I'm a big fan of companies. So stage 2 is when your business starts growing. And when your business starts growing, you start making a lot more money. So you could be like now making a profit of 500K and your turnover is like, say $2 million or to $3 million turnover. And your net profit is 500K. So when it's 500K and you leave all your money here in this company here, there's a bit of an issue. Okay, the issue is it's stuck here and you can't take the money out. And if you did any of my deep dives, taking the money out, you can do it through wages, dividends, and loan. Okay, but the end result is if you want the money out and you want to spend it personally, the end result is you have to pay it as a wage or a dividend. And the tax rate is 47%. Could be up to 47%. So there is one big issue about that. We already got the ownership at 50%, 50%, and we can't change that. So if this person here is earning high income, say $200,000, and then this person's earning, say $0 because they don't work, husband and wife, then when we want to take the profit out, we've got, if we split 250 between the two of them, it's going to be 250 here and 250 here. So this person's income is going to go up by 200 to 450, which is 200K. And this one here is going to be that 250K. So therefore, the tax rate for here is going to be the tax is going to be really high, and the tax is going to be quite high here too, because they're all on the 47% tax bracket. Okay, that's where we have some inner flexibility. Like there's no flexibility here for you to start utilizing the family members. You could have mom and dad, or brothers and sisters, or your kids that are over 18 that you want to distribute profits to, but you can't. And that's where setting up a trust is useful. So that's why we start looking at stage 2 as creating a hybrid structure. In a hybrid structure, if I remove this, is the fact that, so that structure now is this, where you've got multiple individuals now, and a holding trust that can distribute the profits. So we now think about in stage 2, because your business is growing now, the whole goal for us as an accountant is to minimize your tax. My goal right now is to minimize the tax and pay as little tax as possible. And the reason why I want to pay as little tax as possible is because I want you to retain your money for investment purposes, reinvestment for purposes. So reinvestment purposes. And the whole point is to scale as much as you can. So if I told you that if you made like say $1 million in profit, and I told you that the tax rate is going to be 47%, and when you take that money out, you're not going to be a happy person. And also, on top of that, you're going to lose 470K of your money that you've made, and you're only left with 530, which is your after-tax profit, to reinvest back into your business for it to go from 1 mil to possibly 2 mil in the next 2 to 3 years. My goal is, how about if I told you that I can get this down to 25%? Then you have 750K, and then so you can reinvest that 750K elsewhere. So this is stage 2. The stage 2 right now is scale. Our goal now is growth. And how do we grow? Is to minimize taxes, minimize cost. And the only way we can do that is when we make that profit, we find where we can leave the money to pay the least amount of taxes. And having a trust is useful. So we've got individuals here right now that maybe some of them aren't being utilized in terms of income, and all of them can go up to about 30% to 30% tax bracket. All right, we want to look at every single person and pay about 30% in tax and take that money out of the company. Okay, so like I mentioned before, you can pay up to about 135K and pay 30% in tax. But if you go to pay calculator, that 30% tax, it's effective tax. So if you average it out between the three brackets of 16 cents in a dollar, 30 cents in a dollar, and $0 for the 18K, you can probably pay about 150K to yourself. And then 150K is 40K in taxes. Okay, so you'll pay about $40,000 on that 150K. So what is that in terms of the effective tax rate? So if I pay you 150K and you pay $40,000 in taxes, that tax there, the tax rate is technically 27%. Okay, so my goal now is, why don't I put everyone on 150K And the only way I can do that is pay the 25% tax here, take a dividend to the trust, and then split the dividend between all these four parties. And by doing that, I can reduce my income of 600K and keep a tax rate of 27% overall between all parties. This company will pay the 25% tax first, and then take the dividend over into the holding trust and split between it. Because the tax has already been paid at 25%, all these parties don't need to pay the 25% or 27%. What tax do they pay? They pay the 27% minus the 25. So they only really need to pay, and this is very simple maths. So it's not exactly how this is done, but I just want to show you guys anyway. They only, all between 4 of them, pay $12,000 in extra taxes to take that money out. So they can take that money and then reinvest it. Okay, they can either reinvest it back into a new business, or they can reinvest it into buying property. Okay, so that's where you scale. You minimize the taxes overall in the group, and the only way you can do that is having option 4, where you have a trust and a trading company. So if you went back to the previous structure, so let me just unhide everything. Whereas here, there's only 25%, and you only got 50% holding for one individual, 50% holding of the other individual, and it's very hard to distribute the profits because it's 50-50. So if we made 600K profit or 500K profit, it has to be split 50-50 between the two of them. We can pay wages, but then wages then result to superannuation and insurance costs going up. So that's why we like the ability to have a holding trust under a trading company, and that's your stage 2. Stage 2 is scale, and the goal is to minimize as much tax as possible. But there's a problem with this structure here. And this structure here, going back to here, everything is reliant on one thing and one thing only. And that is this beautiful looking thing making $1 million a year for you. Okay? What happens if someone goes after that $1 million? This will all crumble. And that's one thing that a lot of accountants don't think about, and clients and small businesses. What we need to do now, which is stage 3. Stage 3 is de-risk. And this is the part where I tell clients, my job isn't just to minimize the tax. My job is to actually protect your wealth. Whatever you've made in your life for the next, 5 years, 10 years of your life, I don't want it to go to waste. And that's why, when you talk to financial experts, they always say, take some money off the table, put it away, invest it. Okay. I also say the same with your business. Take some money away, take some activities away, take some risk away, and put it away and separate it away from your trading company. And this is the part where you've got this business. It's making you $1 million in profit a year. How amazing would that be, having a business making you profit of $1 million? But then you've got all this money that's just sitting in this company, or paying to yourselves. That's where we need to set up multiple entities for long-term growth, for short-term growth, to separate away from your business if it's too risky. So you might then go, all right, in this business that I've set up, say it's multiple gyms. This gym here, there might be one gym that you look at and it's like high risk. It's like, but high reward. So instead of you setting up the business in this company, or setting up the gym in this company as well, you might separate that company separate that business into a separate company. Then you might go as well, all right, also one big risk about my gym is that I have all these assets, which is equipment, and I don't like the fact that it's all into this company. If someone sues me, they can go after all my assets. So therefore, I'm going to set up a PTY Limited to own all my assets as well. So this is here in option 4. All right, so now stage 3 is de-risking and protecting your assets. So trading company and gym and assets, all of here, it's high risk now. These two here are high risk. This is a business that's making me $1 million. When I go and try to set up these businesses, I'm going to separate them away from my business. And then I also look at trading company and all the activity I have. What is worth protecting that I need to keep if something bad happens? I want to keep these assets. And that I've realized in this gym is my gym equipment. So then when you start buying equipment now, you buy them all in this business and then you hire it or lease it out to your related companies. Okay, so this is stage 3, de-risking and protecting your wealth. If something bad happens to this company now, at least all your assets are there. You can start off new and you might have $1 million worth of equipment in here now that you've not lost. If someone, you just got a bad employee or anything like that wants to sue you, or a business partner or whatever, all these assets are separated here.
Trusted company and holding trust. What are the difference between them? Like in the other one, stage 3, for example, you see that's the trustee company and holding trust. Just if you don't mind, just explaining the difference between the trustee and the holding trust and what we use them for.
Great question. But yeah, so the benefit of a trust is that you don't have, you've given yourself flexibility. Every single year now, you have the choice to distribute your profits. And you don't have the profits just split 50-50 between 2 owners. Okay? If you have like 5 family members in your family, that some of them are earning $0, some of them earning 50 grand, some of them earning 100 grand, we now have the flexibility to utilize their tax rates. All right? But this structure here in option 2 and option 1 doesn't give you that flexibility. And that's the biggest problem, that when your business starts growing and you're trying to scale, I don't want you to be paying 47% or 50% in taxes. And so therefore our goal is, how do we scale and minimize as much costs as possible so we can grow even more? And that's why option 3 is a better structure for stage 2, where we slot a trust in between. The trust owns your assets, gives you some asset protection. We can go on about that. But the main goal for me is find a way to give you flexibility that we can have, a partner that can distribute profits to mom and dad, or even brothers and sisters, or, kids. Yeah. I don't want to go too much of the technicality of like what the difference between a trustee company and a trust is. The main thing is that this trust controls the trust assets, this entity, and this entity is the one that owns the assets on behalf of the beneficiaries. Yeah. And a trustee is just a controller. You can argue that it could be like a director for a company. But we like to separate the trustee, instead of it being the individual, which like where it's a trustee here, the individual could be a trustee as well. But then the trustee is the one that controls the trust and owns everything in their name. And so if this husband or this partner or this wife that runs the business does something bad or gets sued, they go after its assets and it pulls the trust assets into the legal battle as well. So that's why we always try to separate it. Again, this is legal advice. So this don't take this as advice, because you have to speak to a lawyer. But that's why we set up a trustee company. So the trustee company is the one that controls the entity.
A very quick related question you mentioned about the lower age for the payment is 18 for the kids, for example. Is there an upper age for mom and dad, for example? If they are like 80, 85, you still can pay them, or it has to be like retirement in Australia, I think it's 70 years old or
Yeah, so technically you can still pay them, but it just depends on their pension and social security. Are they earning any income personally? Because if they're earning like social security through like the age pension, then it's means tested. So if you give them too much income, then it could like result to them not getting that pension, and they won't be happy about that. So it depends on that. But yes, they could be 80, they could be 90. If they don't receive any pension from like from the government, then they can take that income and lower the tax. Because they're not working, you're just splitting the profits.
What will be the limit, the maximum value for us to distribute the profit to the parents?
Let's look at it. Your tax rates can be like about 30%, right? And you know how I did the calculator at paying 150K, and then the tax was 40% overall? So that 40% is 27%. I think it was when we did the calculation. I think it was like 27%, paying 40K in taxes, right? That works out about 27% in tax. So now you just need to look at all your entities, all the structures that you have, and which structure has the lowest tax bracket, and what are you comfortable at staying at. So this trading company has 25%. This trust doesn't pay any taxes. It's NA. And then you have, and we can go into that in stage 3, but stage 3 has a tax rate of 15%. So now you go, okay, where do I want the money to sit? That's one question. And the second thing is how low of a tax I want to pay as well. The lowest tax bracket, when you look at the average, is about 25% because of the company. So you either leave the profits in the company, pay 25%, or you make sure that the individuals pay something close to 25%. So that's why I selected 150K, because 150K is 27%. It's quite similar to this, so you don't have to pay a top-up tax. I like to generally stay around 25 to 27%.
So for the parents who's actually getting paid for pension, the limit will be very similar, or we shouldn't pay the parents too much?
I can't say for certain because I'm not an expert with like Social Security and how it works, but if you pay them some money, it reduces their pension. So you might not want to use their names. And I have parents that are age pension, and I don't touch them.
It doesn't matter how much you pay them, as long as they receive money as part of the income, their pension will be reduced.
Yeah, will be affected. Yeah, will be affected. And if you affect your parents' money, that you're generally not happy. So that's why, I'm an Asian and immigrant background, my parents get a bit feisty if I play around with their taxes and pension. So I don't go there. So that's why I can't use them.
Okay, so it's better to not use them than use anyone older than 18 years old in the family.
Yeah, I generally don't touch anyone with age pension. Some clients though, and just to explain one last thing, I have a few clients that don't care about the pension, and they rather give the parents the money. And the reason being is because for them, if they were to take out the money themselves, they're paying 50% in taxes, right? Because they're making $1 million a year, and they want to take the profits out to pay the tax. So they're willing to pay 37% to their parents, or even up to 37% tax rather than paying 50%. And how do they do that? They pay them up to that tax rate of 190K to all their parents, and they say to them that, look, I'm happy for you. I'll fork out the age pension as well and give you the money for the age pension. And the reason why is because they need that money personally in their personal name, and they're taking a whole heap of money out. And usually it's because they're buying a personal asset. Could be a home, could be a house. They could be buying a Lamborghini, a Ferrari, and that's the reason why they need that money out. And they're not willing to pay 50% if they were to take it out in their personal name. So they take it out and gift or distribute the profits to their parents, pay 37% tax, and then their parents help them out with their asset purchase.
Last question is,
yes.
The family members, they all have to be physically located in Australia, or could include some overseas tax residents as well?
Overseas tax residents are generally not a good idea, and I'll tell you why. Because non-residents tax rates are really high. So you're looking at 37%, 30 cents in the dollar on 130K, and then straight away it's like 37% right after 135. It's quite high, yeah, and it's you're basically close to 45% on 190K. But the beauty is, you don't need to pay Medicare levy, which is generally something that happens as well. Generally, people don't like paying Medicare levy, which is extra 2%. So you might rather distribute the profits out.
Yeah, so it's like probably 35% in the end, right?
You're guaranteed paying 30% if you're taking 100K, anywhere between 0 to 135K to pay out to a non-resident.
Yeah, 30%. Okay.
Yeah, which some people might prefer. But my thought is you've got a lower tax rate here.
25. But the money has to stay inside the company as part of the profit. You pay the corporate tax, right?
Yes.
But later stage, say if we still want to distribute the profit from the company, but we still need to pay a little bit more.
Yeah, that's correct. you still need to pay a bit more, 5% extra on top. If you want to give it to an individual, yeah, that's a foreign resident. But again, just be careful because it's a foreign resident, so they have tax rules in their country as well. Yeah, so that's why a lot of people don't do this, because then it starts getting confusing because you give them the money. What happens there on their side as well, you don't even know. They might get double tax. So that's why a lot of people, it sounds like a great idea, but you only got one side of the story, which is the Australian taxes. You don't have the other side if it's like, say, China, or if it's US. Yeah, it gets complicated. And there, I can't really advise you because I'm not a international tax expert. We currently have a hybrid. If both partners are in the same bracket, there's no one else in the family to distribute to, would it make sense to operate a holding trust? Yep. Okay, so this is a really good question. When and how do we start using the trust? Okay, great question. Because there's one thing that I forgot to mention to you guys, which is this beautiful looking thing. And this actually takes you to stage 3. This gives you the flexibility. So stage 2 is scale and minimize your tax. And that's where a bucket company comes in. There's one big issue, like I told you, which is your trading company has so much risk because all the profit that you're making is in this company. So that's why we're trying to separate it. We're trying to move some risky businesses in separate companies. We're trying to move the assets and the wealth in other companies as well to protect it. But there is one thing that it does that we need to also protect, which is what you call retained profits. Retained profits. How do we protect the retained profits? We pay it out. We pay it out as a dividend. If we paid a dividend now and we had a structure like this before, option 2, what happens? You pay a shitload of tax. 50%, 47%, instead of being able to retain it in the company and pay 25%. So that's where our good friend Bucket Company comes along and then goes, all right, we'll take the profits for you. We will pay the profits out to the trust. And then because of stage 2, the flexibility that we created, we can pay the profits now out to our good friend Bucket Company, that gets taxed at 30%. We could technically pay it to the individuals as well, but because we're making $1 million profit every single year, these guys might be maxed out at the highest tax bracket already. They might be at 37, 47. It's too high. So we can't give any more money to these guys because they've got their investments and individual investments as well. They generating passive income. They may be on a wage as well. So we can't pay them anymore. So therefore, we've got this Bucket Company that's going to house all our profits. And so if someone goes after this company, I'm not a lawyer, but the profits isn't there anymore. So that's there, my friend, is how you de-risk and protect your wealth. You've moved your assets away, your expensive assets away from your trading company. You protect that. You move away high risk activity and you protect that and keep it there. Well, it's not really protecting it. You're just shooing it away just in case something goes wrong. And then in your trading company, there's all this profit. Take that profit out, put it into a Bucket Company, invest using that Bucket Company, and that Bucket Company doesn't do much risky things. So therefore, your assets are protected, your wealth is protected. And if something were to happen to this, you can like, it's not going to be nice, but at least you still have your assets and your wealth.
So the Bucket Company need to issue the invoice to the holding trust or issue the invoice to the trading company?
Well, why is there a requirement of invoice? So if this is the shareholder of this, it's a dividend, and then a trust can distribute profits, right? Remember how I mentioned a trust distributes profits to its beneficiaries? The Bucket Company can be a beneficiary. So there's no like management fee or investment. And if you did do a invoice, I think someone mentioned this before. One of my clients, they said that it's like part 4A, it's risky because you're creating a scheme to minimize the tax and avoid tax. But if you're distributing profits, it's okay. But if you how do you prove that this Bucket Company did work for this company if you're issuing invoices between the two of them? Yeah, but you're allowed to distribute profits using a trust.
Very quick one about the SMSF.
Yeah.
What's the role it plays in this set?
Yeah. Okay. I love your questions, by the way. Everything I forget, you guys just make sure that I don't forget it. So it's great. So SMSF there is, you can already see the benefit, right? You can see it by seeing the tax rate. What's the tax rate for SMSF? 15%. What's the tax rate when you retire, and that's when you're over 60 years old? It's 0%. The last thing I want to mention to you is that all these investments here, they're all for like, the next 5 years, the next 2 years. It's all considered short to medium term investments, right? You're moving your assets here for short term because you want it to grow and then you can take the money out. Same goes to this bucket company. 5 to 10 years, you might sell it and then you make the profit and you live off the passive income or whatever. You might invest it into a positive geared entity and then you just live off the passive income. It's like a short term to medium term goal, all right? But the SMSF is the long term game where you can't access that money until you're 60, but you've got the lowest tax rate possible, which is 15%. You can't get that anywhere when you're starting to make $1 million in your businesses. So therefore, if you want to play the long-term game, when you do turn 55 to 60 or and when you can start accessing your money, that's where you start, distributing or contributing money into your super fund and you start investing using that too. Again, not financial advice that I'm providing to you. It's just a whole lot of what I see clients do, that they need to start possibly moving some of their funds onto a bucket that has long-term growth, with the lowest tax bracket that you can find. Cool. And that's where SMSF comes in, and it's really important for you. And what advice would you give, or who is best equipped to advise for the following scenario? Most likely, next step is to scale up, likely to start serving our clients overseas, working in America and US, set up LLC in USA versus PTY Limited Ireland, versus invoice everything through a PTY Limited company, versus alternative option here. Okay, I'm so sorry to do this. I feel like this is a cop-out, but I can't advise on US taxes and I cannot advise on Ireland taxes because I don't know the rules in that. What I have to do is refer that out to you. But there is like a possibility that because you're operating overseas, you can set up an entity overseas. And generally, you're not doing this for tax reasons, but because it's the fact that you have customers overseas and it makes more sense. But generally, when you do it overseas, that jurisdiction will have a lower tax rate. And reason being is because bloody Australia has the highest tax rates in the world. It's one of the countries that have the highest tax rate. So yes, there are benefits of having a offshore entity that in a lower tax jurisdiction. But the main thing is that you can't be seen as setting up a activity or a venture that looks like you're just doing it for tax purposes. But in your case, what you have mentioned is that you're looking at scaling and setting up a business overseas because you have overseas clients. That makes sense to me. And it's actually better to have a company overseas. I just can't give you advice on it. The bucket company wouldn't work without the holding trusts. Must be a beneficiary. Yeah, I believe so. If you have a bucket company set up separately and you don't have the trust, it kind of doesn't make sense. How do you actually give the money to the bucket company? The only way you can do it is through a management fee, and the ATO will scrutinize the hell out of that. They'll be like, well, prove to me that the bucket company actually did any work to invoice you that amount. And that's the hard part. And that's why having a trust is better, so you don't have any issues with, they call it Part 4A, which is actively trying to avoid paying taxes. The government would scrutinize the hell out of it. The ATO doesn't like the fact that you're trying to avoid paying taxes. So if you set up a scheme to avoid paying taxes, that will be a problem. That's why a trust is useful. Cool, great, guys. I think that's it. I won't go any further. If you have any questions, feel free to reach out to us. Appreciate everyone, and I really enjoy what I do. And thanks for supporting us. Cool. Thanks, guys. I'll see you later.